Notes receivable. Well, to understand notes receivable, let's talk first just about promissory notes in general. A promissory note is an unconditional promise for one person to pay someone else a certain amount of money at some point in time in the future. We have two parties involved. We have the maker, the one who is making the promise to pay. They owe the money, so to them this is a note payable. We also have the payee, that's the lender. That is the one who is going to receive that payment. To them it is a note receivable. Now for our purposes in this chapter, we're on the good side of things. We are the lender. So to us it is a note receivable. A promissory note has to include some things. First off, the date the note is issued, the principal or face value of the amount being borrowed, the interest rate, and then the two parties who are involved in it. Here's an example of one we looked at back in chapter 1. Here we have Samuel Mason is promising to pay Cook County Bank and Trust $1,000, making that promise on May 20th. He's going to make the payment on August 18th, and he's going to pay back the face value of $1,000 plus also interest at the rate of 8%. Who would you rather be in this transaction? Would you rather be Samuel Mason or would you rather be Cook County Bank and Trust? Cook County Bank and Trust. Okay, well that's one because we're going to receive that payment. On August 18th, we're going to receive that $1,000 plus the interest. The payee, the one who's going to receive the payment, calls this a note receivable. It would be a current asset if it matures within 1 year. More than 1 year from now, it would be long term. The note maker calls it a current liability. If it's due within 1 year, would be a long-term liability more than 1 year. The maturity date is the date on which the note must be paid. The date the note matures and payment is supposed to be made. The maker is supposed to pay the payee on that date. The maturity date can be stated a couple of different ways. Number one, it can be stated on demand. That says whenever the person holding the note decides the note is due, that's when it becomes due. That made me a little bit nervous if I was a borrower. Normally, it would be one of the next two items. It might be on a specific date. That last one I just showed you was what, on August 18th? Okay, that's when that note becomes due. Most of the ones we do will be a number of days from today. There'll be a 30-day note or a 60-day note, and that is how many days from today. Now, when we're trying to determine the maturity date, we have to ask ourselves, what days do we include and which ones don't we include? The rule is don't count the date the note is issued. Start counting the next day and count all the way through and include the final day. Not difficult if the note's within 1 month, but whenever it crosses a month, sometimes we have to get our fingers out. Let's suppose we have a 5-day note. I get it on December 29th. We're trying to decide when it matures. We don't count December 29th. We count December 30th, 31st, January 1st, 2nd, 3rd. That note matures on January 3rd. So don't count the date the note is issued. Start counting the next day, count through, and include that last day then. What's the drawback about borrowing money? You have to pay it back. Normally, the first answer I get is you got to pay it back. Yes, you have to pay it back. And generally, you have to pay back something more than what you borrowed. If you use someone else's apartment to live in, they're going to charge you some rent. If you use someone else's money, they're going to charge you some interest. For our purposes in this chapter, we're going to be the lender. So someone else is using my money. I'm going to charge them some interest. Well, first off, let's talk about the difference between interest expense and interest revenue. The borrower, will the borrower have interest expense or interest revenue? Expense. The lender will have what? Interest revenue. We have a formula to calculate interest. I would highlight this on your handout there, put a big star, a big box or something, because yeah, we got to memorize this. And I call this formula PRT. It is the principal times the annual interest rate times time. PRT, principal times rate times time. Now, what if I loaned you $1,000 at 6% interest? That 6% interest rate covers a year. So $1,000 times 6%, that would be what, $60 interest? I could charge you $60 interest if you had my money for a year. The most common mistake students make in calculating interest is they do the first two parts of that formula and they leave off the third part. They do principal times rate. Time is the number of days divided by 360 in a year. If they don't have the use of my money but for a month, can I charge them a whole year's worth of interest? That would not be a nice thing to do. Time is going to be number of days divided by 360 in a year. You say, well, wait, there are 365 days in a year. I know. It's a banking convention to use a 360-day year is all I can tell you. So we're going to use a 360-day year. Principal times rate times number of days divided by 360. And the last part of that formula gets it down to whatever portion of a year it is I'm calculating interest for. All right, let's get our calculators out. And this is going to sound silly, but I want you to punch things into your calculator exactly the way I tell you for this one. We're trying to calculate interest on a $10,000, 10%, 95-day note. So my formula would be 10,000 times 10% times 95 over 360. All right, here's where, let's clear your calculator. We're going to do this together. I know this sounds silly, but there's a reason for it. All right, I want you to push the 10,000 into your calculator. Punch 10,000. Then push times. Now, if you had the fancy calculator, you can type in 10 and then push the percent button. What if you got the dollar store version of the calculator? No percent button for you. What are you going to do instead? 0.1, exactly. Times 95 divided 360. Let's carry our final answer out to a penny in terms of rounding. What is the amount of interest on this note? $263.89. Do we agree? I was very particular about that. 10,000 times 10% times 95 divided by 360 is $263.89. Here's what I don't want you to do. I get some people who decide to do what's on the right of that equation first. They take 95 divided by 360. And that gives you 0.26389 actually. And they say, that's like 26%. So they go 10,000 times 10% times 26% and they get 260. They're close, but are they exactly right? No. So the only place I want you to round is when you get your very final answer, round it to the nearest penny. Principal times rate times days divided by 360. The maturity value is the total amount that must be repaid whenever the note matures. It is the face value plus all of the interest on the note. This one's not on your handout either. Just follow along with me. We get a $2,500 10% 90-day note. I want you to calculate the interest on that note for me, please. Calculate the interest, $2,500, 10%, 90 days. But if you're going to mess up that formula, normally the thing people do is they leave off the number of days divided by 360. That is what students miss, which means you're going to be very greedy and you're charging them a whole year's worth of interest instead of a certain number of days worth of interest. Okay, the interest calculation, PRT, it's going to be your principal of $2,500 times 10% times 90 divided by 360, $62.50. The maturity value then would be the $2,500 principal plus the $62.50. Says when the note matures then I should be paid $2,562.50. Face value plus all of the interest. Notes receivable. Now we've talked just about promissory notes. Notes receivable. What is a note receivable? Somebody owes me money. They sign a promissory note. Not only did they just promise to pay, but they signed a promissory note because they put their promise in writing. With an accounts receivable, they just promised to pay. Now they have put that promise in writing. There are some advantages to having. Number one, we get interest income. Now, the accounts receivable sometimes bear interest, but notes receivable like all the time do. We have a stronger legal position if we have an accounts receivable instead of a notes receivable. If that person were to declare bankruptcy and all the creditors have to get in line trying to get their money, we're in a little better position. We also can sell or discount a notes receivable at a bank and get cash for it. You know, a notes receivable is nice, but I can't pay my bills with it. And so I can actually get cash for a note receivable by discounting it at a bank. And actually, I can even sell accounts receivable. There are people around who will buy my accounts receivable, and I can get cash for them also, although we really aren't going to cover that. Let's talk about receiving a note. When I receive a note, there are a couple situations might lead to that. Number one, I might loan some money to somebody. I might sell something to someone and they sign a promissory note. Or I might have a customer who owes me money as an accounts receivable. They can't pay it and I make them sign a promissory note. So 3 different situations that could lead to me receiving a note receivable. In all these cases, I'm going to debit notes receivable to make my asset go up. If I loan somebody some money, I'm going to credit cash. If I receive a note because I sold somebody something, I'm going to credit sales. I would have to make the next entry debiting cost of goods sold, crediting merchandise inventory also. And my third time I might receive a note receivable is if I have a customer who owes me money as an accounts receivable and they can't pay, and I make them sign a promissory note. I have more notes receivable, that's an asset, goes up with a debit. I have less accounts receivable, that asset goes down with a credit. Notice in all three of those cases I debited notes receivable to make the asset go up. I credit, well, cash if I loan some money. I credit sales if I sell something. I credit accounts receivable if my customer can't pay the accounts receivable and I made them sign a promissory note. Let's talk next about when a note matures. When the note matures, what's supposed to happen? They pay me. What amount did they pay me? Well, the maturity value. My journal entry when the note matures and they pay me. I have more cash. Cash is an asset. Assets go up with a debit, so I'm going to debit cash for the maturity value to make the asset go up. What's an account that I need to get off my books once that note matures? Notes receivable. It is on my books for the principal. I must take it off for the principal. I want you to get firmly in your mind now the fact that anytime you debit or credit notes receivable, it must be for the principal only. Principal only. That is all that can ever go into the notes receivable account. To make that entry balance, I need to credit to interest income. Remember, we have three words that mean income: revenue, income, or earned. I can credit interest income, interest revenue, interest earned for what we earned this period then. Again, this was not on your handout. Let's just look at it for a minute. I receive a $6,000 30-day 12% note in settlement of an accounts receivable. By that, a customer owes me money as an accounts receivable. They can't pay. I make them sign a promissory note. What do I have more of? Notes receivable is an asset that goes up with a debit. What do I have less of in this case? Accounts receivable asset goes down with a credit. Again, the customer owed me money as an accounts receivable. They couldn't pay it. I made them sign a promissory note. I have given up one receivable, accounts receivable, to acquire another receivable of notes receivable. Did I need my calculator to make that first entry? No, and that really is important. I get people who try to throw the interest in up front. Revenue is recorded when it is earned. On November 21st, have I earned any revenue yet? No. When am I going to earn revenue? Every day that passes that someone else has my money. So as of yet, I have not earned revenue. All right, take your calculator for a minute, and I want you to determine how much interest I should receive on this note first, please. 60? 60 for the interest. Did you get 720? If you got 720, I know what you did. You took 6,000 times 12%. And 720 would be a financer if what? You loaned them money for what period of time? A year. Did you loan them money for a year? No. How many days did you loan them money for? 30. You can't charge them a year's worth of interest if they only have your money for a month. So 6,000 times 12% is 720 times 30 divided by 360 says it's going to be $60 each month. Again, most common mistake people make on the test is they don't multiply by number of days divided by 360. So what's the maturity value going to be? Well, the 6,000 principal plus the $60 in interest. Let's make a journal entry when the note matures. They pay me. It's a good day. They pay me. What do I have more of? Cash. How much cash do I have? 6,006. What do I have less of when this note matures? Notes receivable is right now on my books for how much? 6,000. I must take it off for 6,000 with a credit. Finally, I've earned $60 worth of interest that my credit goes to interest revenue, interest income. Sometimes when the note matures, they don't pay me. If the person doesn't pay me, the credits in my journal entry are exactly the same as if they did pay me. I am still going to credit notes receivable to get it off of my books, because when that note matures, it's got to come off my book. I'm still going to credit interest income also. My debit, though, I can't debit cash. Well, let's forget accounting for just a minute. Let's just think. Somebody owes you money. They signed a promissory note. Note matures. They don't pay you. What are you going to do? Complain. That's a nice answer. Good. What else? Maybe sue. I get people saying, we'll take them to court. Hire a big burly man to go visit them in the dark at night. Whatever. Why is that? Because somebody owes me some money. Now let's go back to accounting. What do we call it when somebody owes me some money? Receivable. I can't debit cash when the note matures. Instead, I'm going to debit accounts receivable. This was a note receivable to me, but once it matures, I got to get it off my books. The customer still owes me money, but now it is an accounts receivable. So notice, it could have begun as an accounts receivable, and I made them sign a promissory note. If they don't pay the promissory note, guess what? It now is reverting back to being an accounts receivable. Why debit accounts receivable? Well, the customer still owes me money and I'm trying to get it. What if I can't collect it? Well, that's what we talked about earlier in this class. Why credit interest income? Students don't like this. Some of them really want to argue with me about that, because how can we credit interest income if they didn't pay me? Well, it goes back to Chapter 1, Chapter 2, the accrual basis of accounting. It says revenue is recorded when it is earned, when we do the work, perform the service. So if I cut your grass and you don't pay me today, but you promised to pay me later on, I've earned revenue. Even though I didn't get paid, I have earned revenue. If I let someone else use my money, I've earned revenue. Even if they haven't paid me, I've still done the work, performed the service, I've earned revenue. The credits in the journal entry, if they don't pay me, the credits are exactly the same as if they did pay me. All that changes is the debit. Instead of debiting cash, I debit now accounts receivable. Let's do an example. We loan $2,000 to Norm, January 1st. Norm signs an 18% 30-day note. Now, I am the lender, not the borrower. I am loaning Norm $2,000. Make the journal entry, please, whenever I make that loan to Norm. What do I have more of? Notes receivable is an asset, and assets go up with a debit. Good. What do I have less of? Less cash, and asset goes down with a credit. Now notice, anytime I receive a promissory note, I'm going to debit notes receivable to make the asset go up. In this case, I credited cash. Why? Because I loaned him some money. I gave him some cash. What if I sold him something? I would instead credit sales. What if he had owed me an accounts receivable that he couldn't pay? I would credit accounts receivable. So the credit will vary depending upon the transaction. How much interest are we going to earn on this note? 30. Good. Nobody gave me 360 this time. Good. 2,000 times 18% would be 360 for a year, but now we are instead calculating it only for 30 days out of 360 is $30 worth of interest then. Next thing we need to know is what's the maturity value of that note. When the note matures, how much are we going to be paid in total? $2,000 principal plus $30 in interest, a total of $2,030. Well, let's make a journal entry, starting off being optimistic. The note matures, and I get paid. What do I have more of? I have more cash. Cash is an asset. Assets go up with a debit. I received $2,030, the maturity value. What do I have less of? I got to get that notes receivable off my books. Got to get the notes receivable off my books. Need to make that asset go down. It is on my books right now for $2,000. I must take it off my books for $2,000. That entry doesn't balance. To make it balance, I need another credit for $30. The credit goes to interest income. Remember, revenue, income, earned, three words that mean the same thing. So debit cash for what I get, the maturity value. Credit notes receivable for the principal only. Credit interest income then for what I earned. Well, let's repeat this, but this time we're just changing one assumption. Forget optimism, go to realism. The note matures, Norm doesn't pay me. Let's skip a line for the debit. Do I still need to credit notes receivable? Yes, I need to get that asset off of my books. When the note matures, I must pull it off of my books. So skip the first line for the debit we'll come back to. Credit notes receivable. When the note matures, I have to get it off my books. Do I still credit interest income? Yes, I did. We've done the work. We have let someone else use my money. I have performed that service. I have earned the revenue. Can I still debit cash like in the original entry? I'm afraid not. He didn't pay me. He was supposed to. Does he still owe me that money? Yes. What do I debit instead? Accounts receivable. We're going to make the asset of accounts receivable then go up. So again, notice it can start off as an accounts receivable, become a note receivable if I make them sign a promissory note, and then if they default on that promissory note, it switches back to being in accounts receivable. Debit accounts receivable, that customer still owes me money. We're going to try to collect $2,030 from him. I didn't ask you this next step, but let's just think about it. What if, after a couple more weeks or months, I give up, Norm's not going to pay me? He will not pay me. I've done everything I can legally to get my money from him. I'm going to have to give up. I got to write it off as uncollectible. That takes us back to the beginning of this class. What account do I debit to write off an account as uncollectible? The allowance for doubtful accounts. Good. What account do I credit? Accounts receivable. Very good. That entry would be for $2,030 then. If he wouldn't pay me, I would debit the allowance for doubtful accounts, credit accounts receivable for $2,030. That last example we did was when I received a note and that note matured in the same year that I received it. Our next topic then is to talk about a note where I get it 1 year, it doesn't mature until next year. I receive it 1 year, it does not mature until the following year. If that's the case and the note crosses over year end, we're going to have to make an adjusting entry at year end to accrue our interest. Now this is actually an entry I already held you responsible for back in chapter 3. You might recall, I know that's been a while. We're going to debit interest receivable and credit interest income. The effective closing entries, let's just review that. Do we close out interest receivable? No, it is an asset, so it still has its balance that carries forward until the next year. Do we close out interest income? Yes, we do. So it does not carry its balance forward to the next year. When the note matures, now, we're still going to debit cash for the maturity value or accounts receivable if I don't get paid. I'm still going to credit notes receivable. I have a new credit now, though, to interest receivable. I'm going to have to get that asset off my books for whatever amount I recorded in the adjusting entry. My credit to interest income is only going to be for how much interest I earned this year. It will not include anything that I earned last year. So here's what my entry looks like. Debit cash for the maturity value, credit notes receivable for the principal, credit interest receivable for whatever you accrued in the adjusting entry, and credit interest revenue for what you earned this year. Let's go to page 20. Cliff receives a $4,000, 12%, 90-day note from Carla in settlement of her open account. What does that mean? Carla owes him money as an accounts receivable. She can't pay, and he requires that she sign a promissory note. I want you to take a minute and to make that entry on December 1st, please. What do I have more of? Notes receivable and asset goes up with a debit. Good. And what do I have less of? Accounts receivable and asset goes down with a credit. So I have more of one asset of notes receivable. I have less of another asset of accounts receivable. Every time I get a promissory note, I debit notes receivable. Sometime I credit cash, sometime I credit sales. In this case, I credit accounts receivable. That happened on December 1st. This is a 90-day note. This note is received in 2013. It won't mature until 2014. As of December 31st, Carla has had the use of our money for how many days? 30. I need to make an adjusting entry to accrue 30 days worth of interest. I want you to take a minute and calculate that amount for me, please. How much interest have we earned in 30 days on this note? $40, do we agree? 4,000 times 12% is $480 for a year. I'm going to calculate it only for 30 days out of 360. $40 worth of interest. I have earned $40 worth of interest. Have I received it yet? No. Does somebody owe it to me? Yes. What do I have more of? Interest receivable. Specifically interest receivable. Normally students first say accounts receivable and then they say notes receivable and then we get to interest receivable. All three of those are receivable. That's good. But accounts receivable is what my customers owe me. It doesn't include any interest. The notes receivable account is for the principal only. You can never touch notes receivable except for principal. The interest my customer owes me goes to a separate receivable called interest receivable. More interest receivable and asset goes up with a debit. What else do I have more on? Interest income, revenue, or earned. Any of those three is fine. They go up with a credit. More interest receivable and asset goes up with a debit. More interest revenue goes up with a credit. Now let's think about the closing entries. Interest receivable, will we close that out? No. So it still has that balance on my book. Interest income, will I close that one out? Yes. So that's gone. That's closed out. It doesn't carry its balance forward to the next period then. Let's move on to the next year. Carla will have the use of Cliff's money for how many days in 2014? 60. Now there are two ways to figure this. One is, and I'm sure nobody did it this way, we could count up and see when that note actually matures, and we would find that it matures actually on March 1st, which is 60 days. If you got 60 though, here's what you did. You said it's a 90-day note. 30 days were last year. 90 minus 30 says there must be 60 days this year. That's good. The only thing I'm going to caution you about, if you just do this subtracting way, that's going to be fine, assuming that you got the number 30 right. But guess what? If you missed the 30, then you're also going to miss this 60. So you really probably want to look at it both ways to make sure you got the right number of days. I want you now to calculate how much 60 days of interest is going to be that I'm earning in the year 2014. How much is 60 days worth of interest? 80. Which, of course, is twice what it was for 30 days. Now, folks, my numbers are coming out nice and neat. You think in the real world they're going to come out nice and neat? No. Okay. So just don't get too confused by that. The next thing I want you to calculate is the total amount of interest that I'm going to earn on this note, 120. Now, there really are two ways to figure this. If I were you, I'd do it both ways. First off, I'd go back to my PRT formula. Go back to the PRT. Principal times rate times number of days. The total number of days is 90. Principal times rate times 90 days divided by 360 is a total of $120. Now, if you did it very quickly, what I think you probably did is you said, well, 40 plus 80 is 120. That's true also. If I were you, I'd do it both ways to make sure you get the same answer, because otherwise you might make a mistake. We don't want that to happen. So the last number we need to know is what is the maturity value of this note. And the maturity value is how much must be paid when the note matures. Well, it's a principal of $4,000 plus interest of $120. Says they are going to pay me $4,120 when this note matures. Let's make a journal entry. What do I have more of? Cash. How much cash do I have? Well, the maturity value of $4,120. We're being optimistic in this example, assuming that they pay me. What is one account I need to get off of my books when this note matures? Let's do the notes receivable first. Okay, the note receivable is on my books right now for how much? $4,000. I got to take it off my books for $4,000. Again, I didn't need my calculator to figure the $4,000, did I? It's what's already on my books in notes receivable. What is another account that I don't need my calculator to figure it right now, but another account that's on my books that I need to wipe off my books? The interest receivable is on my books for $40. I need to take it off for $40. Again, I don't need my calculator for that one either, do I? Whatever I recorded in my adjusting entry is how much I'm going to credit interest receivable for. Those don't balance. To make it balance, I need another credit for $80, and that credit goes to my interest income. Now, I want you to think about this note for a minute. It was a 90-day note. 60 days of that is interest to me this year. That's the $80 in revenue. The other 30 days was interest to me when? Last year, exactly. So notice, I don't record $120 worth of revenue this year. I only have $80 revenue this year. The other $40 I recorded as revenue last year. I'm getting the receivable off my books now. Let's take this example one step further. Carla, forget optimism. She doesn't pay. No mature, she doesn't pay. Let's skip the debit. We'll come back to the debit. Do I still credit notes receivable for $4,000? Yes. Do I still credit interest receivable for $40? Yes. Do I still credit interest income for $80? Yes. My credits are unchanged, whether they pay me or they don't. What does change is my debit. I can't debit cash, can I? Instead, I'm going to debit what instead? Accounts receivable. The customer still owes me money. I am going to try to collect that $4,120 from Carla. What if I can't collect the $4,120? I'd have to write off her account as uncollectible. That would be a debit to the allowance for doubtful accounts and a credit to accounts receivable. So the credits in the journal entry are the same whether they pay me or not. All that changes is my debit, not to cash, but now to accounts receivable.